Hi, this is Hutch with BankingTruths.com, and today we're going to tackle the most confusing subject with whole life insurance: direct recognition versus non-direct recognition, and all the myths. So I like to use this simple mnemonic device, kind of like when I was in grade school learning about fiction, nonfiction, secular, non-secular. So what I want you to do is use the word effect with direct to take away the confusion. So with direct recognition loans, there will be a direct effect on your dividend on that loan money. Conversely, with non-direct recognition loans, there will be no effect on your dividend on loan money. And so that brings us to myth number one, which is simply that non-direct recognition must be better than direct recognition. And nothing could be further from the truth. In fact, the top dividend paying whole life policy for over a decade now has been using direct recognition. And when you think about it, it just makes sense. So direct recognition carriers pay two distinct dividend interest crediting rates. One for those with on cash value where there's loans against it, and for the rest of the general account where there's no loans against the cash value. Conversely, with non-direct recognition loans, they pay one single dividend interest crediting rate for all policyholders, whether they have a loan or not. And that leads you to believe that those without a loan are kind of subsidizing those with a loan, especially in today's low interest rate environment. And what you're looking at here is pretty true to form. So with direct recognition, the non-loan dividends are the highest in the business right now. And when you take a loan against the policy, what they will do is they will have a direct effect against your dividends only on that loan money. And so those dividends will be substantially lower, and even lower than those of the best top performing non-direct recognition carriers. And this brings us to myth number two, which is direct recognition dividends on loan money are always lower than that of non-loan money. And what's really ironic about this is when Nelson Nash wrote the book, The Infinite Banking Concept, Becoming Your Own Banker, all his examples were using the top direct recognition policy of that time. And in that time, the loan rate of that policy was 8, and the dividend rate was in the 7s. And so when you took a loan against the policy, it would actually pull the dividend up. The direct effect on the dividend was the carrier would give you a little bit of a bonus. So the truth is, when the loan rate is higher than the dividend rate, then the direct recognition dividends on loan money are actually higher. And again, when you think about it, it just makes sense. Direct recognition just causes a direct effect. And there's two distinct dividend interest crediting rates. So if you're borrowing against the policy at a rate higher than what you'd earn if you weren't borrowing against the policy, then the carrier should give you a bonus. In today's day and age, the loan rate is lower than the dividend rates. And that's why the direct effect is they're pulling your dividend down a little bit. And that brings us to myth number 3, which is my whole life policy will perform better if I use the policy loan than if I don't. And I have a lot of prospects and clients think this, especially after researching on the internet and reading Nelson's book, and nothing could be further from the truth. So it only happens when the loan rate is higher than the dividend rate, and that hasn't been that way for a long time. So the truth is, it's best to get the lowest loan rate possible, even if it's from an outside lender. And we're going to talk about this later in the video when we show you some examples of how to equalize the loan rate of both direct recognition and non-direct recognition, and actually bring it down from the current norm, which is around 5%, down in the low to the mid 3s. And that extra 1.5 points, 1.75 can make a huge difference. And that brings us to myth number 4, which is I will be borrowing against most of my cash value most of the time. So when all these agents and carriers that are touting non-direct recognition as like a must-have, that assumes that, again, you're borrowing most of your cash value most of the time. And the truth is, most clients are drawn to banking because they're very conservative, and most of them are going to use loans very sparingly and strategically. Now, that said, I do have nosebleed entrepreneurs and uber aggressive real estate investors that are almost fully leveraged all the time. And again, when you use these outside loans, you can get up to 95% loan to value. And so if that's the case, then the direct recognition, non-direct recognition doesn't matter when you're using an outside loan, because it's not that the loan company is going to report to the carrier, hey, so-and-so's taking a loan, you better give them the smaller dividend over there on the left. That doesn't happen. They credit you the non-loan policy value dividends because you're not taking a policy loan when you're using an outside loan. All right, I'll bet you're ready to look at some numbers. But before we jump into scenario number one, I just want to remind you that your numbers are going to look totally different. And even though these concepts are pretty universal, I'll bet you want to see what your custom tailored banking policy would look like. So you could use that link below to book a spot on our calendar, and we're happy to help model things for you. So scenario number one is going to be a male age 37, not preferred plus, not preferred, but standard non-tobacco. And we've designed this policy with the maximum term rider, the maximum PUA rider to fit in $16,000 of maximum premium for the first 7 years. After that, we're going to taper it off to only $6,000 of annual premium from years 8 to 10. It's still more than the base, but not quite the max premium. And after that, we're going to do a reduced paid up scenario in year 10 to totally shed these policies of all mortality and make them growth machines. And then we're going to look at just lots of loans. So let's look at years 1 to 10 together. So you see the direct recognition policy and the non-direct recognition policy have the same premium structure. However, when we look at the dividends, it's a different story. Even by year 10, there's substantial differences. And that translates to higher cash value for the direct recognition policy by year 10. Of course, there's no income, there's no loans, so it's just what we had talked about before. Now, what you just saw was this, the first 10 years. Now, if we look at the banking phase after funding, we see lots and lots of loans, big ones too. And if we zoom in and look at what that means to the policy, you can see that the dividends, even though they start out higher for the direct recognition policy, they start to taper off a bit. And even, I do want to say, even though the loan structure looks a little bit different for the non-direct recognition carrier, it's just because they mash up the loans and the payback versus with the direct recognition carrier, it's unbundled. But when you do the math, it's the same loans. So we can see that the direct recognition dividends actually get penalized every time there's a big loan taken out versus the non-direct recognition carrier. They start smaller, but then they just keep cruising upwards. Now, if we zoom over here, you see this new non-loan dividend column. And what that is I ran the same illustration with no loans on the direct recognition carrier. And we can see that the dividends are substantially higher. Now, some of you are thinking, wait a second, I got this policy so I could borrow against it. Yes, you did. But remember, we can use these outside lenders to levelize the loans for both the direct and the non-direct recognition carrier. Currently, they're both at 5%. One's affecting you, one's not affecting you. But if we can get a loan from an outside lender at 3.5 or 3.25, and neither one of them are going to affect you, I call it synthetic non-direct recognition. Isn't that a better situation when you're talking about six-figure loans? Of course it is. So what we're going to do now is we're just going to isolate the purple dividends, the blue dividends, the red dividends, and you tell me which ones you'd rather have. So if we gray out all the other columns, the purple dividends, the blue dividends, the red dividends, and honestly, we don't even need the red dividends here because we're going to equalize the loan for both of these carriers. They're both at 5%. We're going to equalize by getting a 3.5 or a 3.25 loan from an outside source. They're not going to report it to the carrier, so there's going to be no effect. Again, looking at these two columns, which dividends would you rather have? It's obvious. So now let's fast forward 5 years and look at our 37-year-old male in retirement. He's going to retire at age 67 and he's going to withdraw to basis and then borrow almost $27,000 a year for 20 straight years from age 67 to age 86. Now about the withdrawing to basis thing. We've found with whole life a lot of times rather than just straight borrowing the entire time, to just withdraw what you've put in first, it's usually exhausted after the first 4 or 5 years, or at least is in this scenario. And then after that, you take loans for the rest. It's a tax-free withdrawal. You surrender your least efficient PUAs. And if we look at the effect on the dividends, this is the full retirement scenario. Again, age 67 to age 86. we can see for the first 4 years, the difference between the non-loan dividends and loan dividends on the direct side are exactly the same. They start to diverge from year 5 on. That's because loans have kicked in. You've exhausted all your basis and now you have to borrow so you don't pay tax. Now, comparing that to the non-direct recognition side, again, you see that you're starting with a much higher dividend. And if you just focus on strictly the loan dividend side, the non-direct, it takes a while to catch up, but then it starts actually lapping our direct recognition loan dividend. Keep in mind though, in spite of the fact that the direct recognition dividend gets squashed by taking a policy loan, you still end up with more cash value than the non-direct recognition side. And that's because of all the years that you didn't borrow or borrowed from an outside loan that you got that higher dividend and started with a higher dividend in this case. It results in more total net cash value as well as more total net death benefit as well. What that means is you would have an even greater capacity for income using the direct recognition policy, even without anything fancy, just using the standard direct recognition loan, which compresses the dividends. But hold the phone just a second. Remember, we can equalize these loans. So the 5%, whether it's direct or non-direct, doesn't even matter. When we can get 3.25, we'll even just model 3.5 using these outside lenders. And when you use these outside lenders, they don't do a direct effect on your dividend. You get the non-loan dividends just as if you weren't taking a loan. Well, let's just cut to the chase and show you the results. Over there in green is the policy loan, exactly what you saw with the 5% direct recognition loan, having those compressed dividends. It still beat the non-direct recognition at $234,000 of cash value. Now, over there in the pink, this is the direct recognition policy, but using an outside loan for the bigger non-loan dividends. Plus, we lowered the loan rate from 5 to 3.5. And you can see you don't quite have double, but you have considerably more cash value. In fact, you could have had taken bigger retirement loans, which we'll model in just a second. And you also have a lot more death benefits. So this is a ton more capacity. And just to show you how we did this, this is with our brand new banking calculator. And what we did is we just modeled an outside loan, and then all the policy data that you see here is just the policy growing. And then we model the loan by building it on the outside, and that leaves us with the net value. So you actually have 1.2 million of cash value in there, collecting guaranteed interest and non-guaranteed dividends. And after we take the 3.5% loans, well, you're left with a 788 balance, which leaves you 426 of net cash value. And 1.476 of death benefit left, less the loan, is 688. Now, some of you are concerned that, well, wait a second, I don't know if I want to be juggling these outside loans in retirement. But remember, the direct recognition policy has this special overloan protection rider. So you can use these outside loans, and when you feel like you just can't manage them anymore, you could refi the loan back into the policy loan, sever ties with the outside lender. You always have that capacity in the policy, and then you'd be entitled to this overloan protection rider that doesn't let your policy blow up as long as you're past age 75 and the policy's been in force for 15 years. It doesn't matter if you roll this huge lump sum loan back into the policy. So let's change the existing loan to instead take $26,929. Let's take an extra $1,000 a month, $38,929 of annual retirement income, not at 5%, but at 3.5% using this outside loan. And the reason we left so much cash value and death benefit behind in the last scenario is because $26,000 was the most we could take using the non-direct recognition policy, using its policy loan. But by reducing the loan rate and getting those higher direct recognition non-loan dividends, what we're able to do is take substantially more income. Again, an extra $12,000 a year for 20 years from age 67 to 86. And you can see the policy's only left with $75,000 of cash value, but there's still $336,000 of death benefit left behind at age 86. And again, you could always refinance this outside loan if the parameters stop being as good or you were just too nervous about overloaning it or having it blow up. You could always refinance it back to the direct recognition policy and have that protection of the overloan protection rider. So, regardless of what you've heard, what you've read, what you've come to believe about direct recognition and non-direct recognition and the hooey of using the magic of a policy loan, don't buy into the hype. Test and measure the numbers for yourself. We're in the habit of modeling the very best direct recognition and non-direct recognition for our clients and showing them true to life loans for their situation. We're happy to do that for you, but regardless, I hope this video helped clear up some of the confusion around this very misunderstood subject.